A woman in Phoenix opened her retirement statement last year. Same account she'd ignored for a decade. The safe half, the part her advisor swore was the boring, sleep-at-night money, was down 17%. She called the bank. She asked one question: how does the safe part lose money? The person on the phone went quiet, because the honest answer is something almost nobody is taught, and once you hear it, you can never unsee it. That number on her statement wasn't set by her bank. It wasn't set by the stock market. It was set by a machine most people have never looked at once in their entire lives. A machine worth around $145 trillion, bigger than every stock market on the planet combined. And it quietly sets the price of your mortgage, your car loan, your rent, your job, and your retirement. This is the bond market. And here's the uncomfortable truth this whole video is built on. If you don't understand bonds, you don't actually understand money. You just understand the part of money they let you see. I'm going to fix that in the next 15 minutes. No finance degree, no jargon you have to pretend to follow. By the end, you'll read the economy better than most people who do this for a living. Let's go. A bond is just an IOU. Let's strip this down because everyone makes it sound harder than it is. A bond is an IOU. That's the whole thing. Somebody needs money, a government, a company. Sometimes a city that wants a stadium it absolutely cannot afford. Instead of walking into a bank, they borrow it from regular investors. You hand over $1,000. They promise you two things: a fixed payment every year, called the coupon, and your $1,000 back on a set date, called maturity. When the US government needs cash, and it always needs cash, it sells treasuries. When Apple wants cheap money, it sells corporate bonds. When a shaky company borrows, those are junk bonds, which Wall Street rebranded as high yield because junk doesn't sell well in a brochure. Simple so far. A loan with a receipt. Now here's the one idea that 90% of people get wrong, and it's the secret engine behind everything else in this video. The one rule that runs everything. Picture our stick figure. He buys a $1,000 bond paying 2%. He gets $20 a year. Boring. Fine. A year later, interest rates rise. Brand new bonds, same $1,000, same borrower, now pay 5%. That's $50 a year. Now our guy needs to sell his old bond. He walks up to an investor and says, "Want this? It pays $20 a year." And the investor laughs. "Why would I buy yours for $1,000 when I can buy a new one paying $50 next door?" His bond didn't change. It's still paying exactly what it promised. But it just became the financial version of a used phone 2 models old. Works perfectly. Nobody wants it at full price. So to sell it, he has to drop the price. He keeps cutting until that fixed $20 actually works out to 5% for the buyer, which means selling his $1,000 bond for somewhere in the 700s. He just lost a couple $100 on the safe investment. Here's the rule. Tattoo it on your brain. When interest rates go up, existing bond prices go down. When rates fall, bond prices go up. That's it. That's the lever. Every disaster in the rest of this video, the collapsed bank, the fired prime minister, the trillions in vanished retirement money, is just this one rule operating at a bigger and bigger scale. And the first place it touches your actual life is in a single number, the one number that prices your entire life. If aliens landed and asked to see the one number that runs the human economy, you wouldn't show them the Dow. You'd show them the yield on the 10-year US Treasury. Here's why you should care, even if you never buy a single bond. When a bank gives you a mortgage, it doesn't invent your rate out of thin air. It looks at the 10-year Treasury and asks one question: why would I lend money to a random human for 30 years when I could lend it to the US government, basically risk-free, at this rate? The answer is, it wouldn't. Not unless you pay more. So the bank takes the Treasury yield and adds roughly 2% for the risk that you, a regular person, might lose your job. That's your mortgage. Watch how cleanly this works. Back in early 2021, the 10-year sat near 1%, and mortgages hit 2.65%, the lowest ever recorded. People borrowed like the money had an expiration date. Home prices jumped 19% in a single year against a long-term average of about 4%. Then the 10-year climbed. Mortgages crossed 8% by late 2023, and the housing market froze mid-bite like someone paused a nature documentary. Your bank didn't do that to you. The bond market did, and it doesn't stop at houses. Car loans, credit cards, student loans, the rate your city pays to build a school, the rate your boss pays to grow the company, all of it is priced off treasuries. When yields rise, every borrower in the country gets a rent increase at the same time. Companies that loaded up on cheap 3% debt in 2021 suddenly had to refinance at 7%. And when your interest bill doubles, you don't post about it. You cut costs, which is the polite phrase for layoffs. A real chunk of the job cuts in 2023 and 2024 weren't about a weak economy. They were the bond market quietly repricing everyone's debt. One more trick before we move on, because this one is almost spooky. The bond market predicts recessions better than nearly every economist alive. Normally, lending for 10 years pays more than lending for 2. Longer wait, bigger reward. But sometimes that flips, and short-term bonds pay more than long-term ones. It's called an inverted yield curve, and it means investors are so scared of the near future they're stampeding into long-term safety. That signal has correctly called every U.S. recession since the 1950s, with basically one false alarm. Your horoscope wishes it had that record. While the news argues about vibes, the bond market just quietly raises its hand and says, "Trouble's coming," and it's almost always right. There's an old line from political strategist James Carville. He said he used to want to come back as a president or the Pope, but now he'd come back as the bond market because the bond market can intimidate everybody. He wasn't joking. In a few minutes, I'll show you it intimidating an entire country into firing its leader in 45 days. But first, we need to kill the biggest lie in personal finance. If this is making things click, take 1 second and subscribe. Real-world economics. That's the whole pitch. This is the stuff school skipped. Okay, back to it. The biggest lie in personal finance. For decades, every advisor and every retirement brochure told you the same thing. Stocks are the risky part. Bonds are the safe part. Put 60% in stocks for growth, 40% in bonds as your seatbelt. Then 2022 happened, and the seatbelt strangled everyone. The Fed raised rates from near 0 to over 4% in 9 months to fight inflation. And remember our rule: rates up, bond prices down. The broadest U.S. bond index fell 13% that year, its worst year on record. Long-term treasuries, the safest assets on earth, got obliterated. Some long-dated treasuries lost around 39% in a single year, the worst stretch for those bonds in over 2 centuries. The classic 60/40th retirement portfolio lost about 17%, because for the first time in decades, bonds didn't cushion the stock crash, they piled onto it. Millions of retirees opened their statements and found out the safe part of their money was the part bleeding. So were they lied to? Sort of. Here's the part nobody explained. Bonds protect you from one risk, the borrower not paying you back, and the U.S. government will always pay you back. But there are 2 other risks hiding in the fine print. Inflation, which quietly shrinks what your fixed payments can buy, and the big one, interest rate risk, which is everything we just covered. And there's a number that tells you exactly how exposed you are. It's called duration, and it's the most useful word you've probably never heard. Duration tells you how much your bond drops for every 1% rise in rates. A fund with a duration of 6 loses about 6% when rates rise 1 point. A long-term treasury fund with a duration of 17 loses about 17% per point. In 2022, rates rose more than 4 points. Suddenly, grandma's boring bond fund was moving like a tech stock without the fun parts. Now watch this same math take down bigger and bigger targets. The dominoes. Domino 1, a bank. Silicon Valley Bank, March 2023. It took in a flood of deposits and parked over $90 billion in long-term bonds, the safe stuff. Then rates spiked, and by the rule you now know, those safe bonds quietly lost billions in value. When the bank had to sell some at a loss and ask for fresh cash, depositors panicked. The 16th largest bank in America went from fine to seized in about 48 hours, killed by the used phone problem. Domino 2, a country. The UK, September 2022. A new prime minister announced £45 billion of unfunded tax cuts. The bond market looked at the math and said, out loud, absolutely not. Investors dumped UK government bonds so hard that yields spiked over a full point in days. That triggered a doom loop inside British pension funds, forced selling, pushing yields higher, forcing more selling. The Bank of England had to step in with emergency bond buying, later admitting some pension funds were hours from collapse. A British tabloid set up a live stream of a head of lettuce next to a photo of the Prime Minister, asking which would last longer. The lettuce won. She resigned in 45 days, the shortest premiership in British history. The bond market fired her. Domino 3, the tiny one that says everything. In 2020, Austria sold a 100-year bond paying less than 1%. People bought it eagerly. Why lock up money for a century at under 1%? Because at that moment, trillions of dollars of bonds worldwide had negative yields. Investors were literally paying governments to hold their money. Next to that, Austria's bond looked generous. Then rates normalized, and that century bond lost roughly 75% of its value. A rock-solid government that will pay every penny back on a bond that traded like a meme stock. One rule: a bank, a pension system, a country, the biggest borrower in history. So you'd think the largest borrower on earth would be playing it careful right now. The US government owes around $39 trillion. Big numbers go numb. So here's the one stat that matters. This year, the US will spend over $1 trillion on interest alone. Not paying down debt, not building anything, just interest. That's more than the entire defense budget. The country now spends more servicing old debt than it spends on the most expensive military in human history, and the bond market noticed. In 2025, the last major rating agency giving America a perfect score finally downgraded it. The country didn't change overnight. The math just stopped being ignorable. Meanwhile, the customers are getting picky. Foreign investors used to hold over half of US Treasuries. Today, it's around 30%. So Washington needs to borrow more than ever, exactly as its most reliable buyers back toward the exit. What does any business do when demand drops? It offers a better deal. In bonds, a better deal means higher yields, which means higher rates for you. We saw it live. In 2025, after a chaotic tariff announcement, investors dumped treasuries, yields spiked, and within days the policy got paused with the admission that the bond market was getting a little queasy. The most powerful government on earth reversed course in under a week. Not because of voters, because of bond traders. And remember the formula. Your mortgage is the 10-year treasury plus 2. Every dollar of new debt, every downgrade, every nervous foreign buyer puts a thumb on the scale that prices your house and your boss's payroll. What you actually do with this. I'm not a financial advisor. This isn't advice. It's the stuff I wish someone had drawn on a napkin for me years ago. Stop donating money to your bank. The average savings account pays around 0.5%, while short-term treasuries and money market funds pay several times that same safety. Treasury interest is even generally exempt from state tax. Your bank is counting on you never watching a video like this. Know the difference between a bond and a bond fund. Hold an individual treasury to maturity, and you get your full money back, guaranteed, no matter what rates do. A bond fund never matures. It gets repriced every single day, so when rates rise, the loss shows up on your statement and just sits there. Neither is wrong, but you deserve to know which one you own before it happens. Check your duration. It's printed on your fund's fact sheet. It's your honest risk label. The retirees crushed in 2022 weren't reckless. They just owned duration they didn't know they had. And watch the 10-year. Takes 5 seconds. When it climbs, mortgages and loans follow. When it drops hard, the market is bracing for trouble. It's the closest thing the economy has to a check engine light, and now you're one of the few people who knows what it means. Here's the thing nobody tells you. You've been in the bond market your whole adult life. Every mortgage payment, every car loan, every dollar in your retirement fund. You were always in the game. You just never got handed the rule book. There's an entire industry that prefers it that way. But now you know the one rule everything runs on. Rates up, prices down. You've watched it take down a bank in 48 hours, a prime minister in 45 days, and trillions in safe money. You don't need to trade bonds. You just need to stop being the only person at the table who can't read the price tag, because the bond market is going to keep pricing your life either way. That's why it's simple. If you don't understand bonds, you don't understand money. Now you do. I'll see you in the next one.